Hey guys, this is Scott Horne and Sohail here with the Owner Finance Network Loan Servicing, and here to walk through how loan servicing really works. We get a lot of questions from a lot of people, and they really want to know, how does this process work from start to finish? So we're going to try to go through and put this in great chronological order for everybody.
Sure.
And work through it.
Yep.
And so you're going to be center stage, mister. I just want to ask you some questions, navigate along the way.
Okay.
So let's go. So, you know, the loan servicing business really starts prior to closing, right?
It does.
So if you're getting ready to sell a property with seller financing, in which you're going to be using loan servicing, what should the seller, the potential note holder, do? What's the first thing?
So ideally, what I would recommend doing is going to our website and downloading the package, the paperwork that needs to be filled out both by the investor and the borrower. Now, the borrower portion, I understand, can only happen at the time of closing, but what I highly encourage all investors to do is download your portion of the paperwork, fill it out, send it over so we can get you set up in the system, and then wait for the closing to take place.
Oh, that's a great idea.
Yep.
I hadn't thought about that.
Yeah. And then when the closing takes place, we need the closing package, which would include like the note, the deed of trust, and the closing disclosure.
Okay. So in other words, get ahead of the curve a little bit.
Yep.
Get the thing filled out, get it over. Get it signed at closing.
Yep.
Get everyone to sign it. Maybe get copies of canceled checks if you're going to do ACH, those kind of things.
Yep.
Get it all to you, and then get you the closing package so you can get it all set up, get ready to go.
Correct.
Pretty easy. I got it. Okay, so we're closed and we're set up. There's huge confusion, though, on when and how the borrower makes their first payment to the servicer. So I'm going to ask you a couple of questions.
Sure.
Let's assume for a minute we close the transaction on January the 15th, let's just say. So when I close a deal in our law office on January the 15th, technically the first mortgage payment is March the 1st. But we have to deal with interest from January 16th through the end of the month.
Right.
We have to deal with escrow from the 16th through the end of the month, and escrow for the month of February in that case.
Correct.
Now, I want to point out, guys, that the March 1 payment pays the interest for the month of February, right? You pay it backwards.
Correct.
But it pays the escrow for the month of March.
True.
So you're paying escrow forward, not backwards.
Not backwards.
So you got to think about that. So what would you suggest that, these sellers, investors who is going to be a note holder do in those situations?
So ideally, what you described is really the best case scenario. That is the ideal way of getting it done. Now I understand that the borrower is already bringing a large down payment in, and there's money involved, which for some borrowers could be too much. Personally, my recommendation is to go with what you just suggested, bring in the 15 days of interest plus the forward escrows. But if that's not possible,
set it up somewhere along the way, right?
Yeah.
So I look at that and I go, you can either collect it at the closing table. There are borrowers who have the ability to do that. It might be tight for others, right? If you can get that done, I think it's beneficial, right?
Right.
Secondly, if you can't, okay, maybe ask that borrower to pay it on the first of the month. Now, that is not going to come to you, though, is it, as a servicer?
So it will not come to us. The escrow portion does need to come to us because we are holding it in a trust account, but the interest can be sent over to the lender. So if the lender receives the entire amount, then as a servicer, what I recommend is to forward the escrow funds to us so we can hold it in escrow and not be, this way we're not chasing after that money at the end of the year when we're paying the taxing authority.
So in other words, what we don't want to do is have the investor get behind in the escrow, if that's the issue. And of course, sometimes what you don't know is if the existing mortgage on the property has an escrow account or not. If they do, and that investor has already paid the January payment and pays the February payment, as a servicer, we don't really care what that looks like at that point in time because the March payment keeps us current. But what we do care about is if there's not an escrow account, we want to make sure that escrow account is funded.
Yes.
So let's take, I want to take another example here for a moment. So let's say we're closing a deal now in August, where the seller is responsible for 8 months of escrow.
Right.
The buyer, let's say his first payment is September the 1st, and starts making his escrow then. So the buyer, by the time the year end comes up, is going to have 4 months of escrow.
Correct.
What about the other 8? What would you suggest the note holder do?
So in a situation where there's no escrow set up with an underlying lien holder, or if there's no underlying lien holder, there are 2 ways to handle this. Number 1 is to collect the funds from the seller.
At the closing table.
At the closing
table.
table.
So they all come to use the service.
Correct. So, and they're forwarded to us. Or when it's time for us to pay the taxes, we can go back to the seller and collect the funds from them and forward the funds.
Or, I'm going to throw a third option out there. Tell me if I'm right or wrong here. You could take those 4 months that you've collected, send it to the taxing authority, and then let the seller who has responsibility, the note holder, pay his balance in a timely fashion. Now, guys, you have various options like this. As the seller and the note holder in that particular scenario, it's really your decision. It's not the servicer's decision because you control the situation. You're the lender. You're the one responsible for those funds. But if you have the ability to pay that at the time of closing, so you don't have to think about it at year end or worry about it and wind up not having the money, take the time, go get it out of the way. It's probably the smart thing to do.
It is, yes. It's very smart to just get it done, get it out of the way, not have to think about it again, and just move on to other deals or go on with your life.
Yeah, and I'll tell you, I've seen problems arise from just those exact things, and you don't like dealing with those things. So we're set up now. Our borrower's making the first payment. How can that borrower pay you? What are their options?
So let me back up just a little bit to explain one step in the process.
Sure.
Once we have boarded the loan, once we have set up the borrower, what we do is within a matter of days, we will send out a welcome letter and a statement so they know where to send the payments to. It's going to be via email and mail. As far as being able to make payments, we offer them several different options. They can mail in a check. They can pay via Zelle. They can pay via Cash App. And the best part that I highly encourage is to do it through an electronic bank transfer. That's the easiest way of doing it.
So that's called an ACH, right?
ACH, correct.
I don't even know what ACH means, to be honest with you. You think I know that an acronym, but I don't.
I don't either. So.
I'm sure we probably guessed at it pretty close if we had to. But I like all those various options. And is that in your intro letter to them?
Yes, it is.
So it gives them all these great ways of doing it. Okay. And again, I think one of the things, I know when I'm closing a transaction for a borrower and a seller, you know, I like to identify these kind of things, tell them how to do it as well. But it's really getting that bar to understand. It's not the date that you mail the check in, it's the date you receive it, right?
Receive it, correct.
And so, unfortunately, if they mail it in on the, let's say the grace period is 10 days, due on the 1st, late on the 10th, they mail it on the 8th, hoping you'll get it by the 10th. But if you get it on the 11th, unfortunately, there's a late charge incurred in there. And that doesn't happen to the borrowers in the seller finance deal. That's for all of us.
For all of us.
Anybody in this country has a mortgage. We're treated the same way, right?
True.
So none of this is really abnormal. It's all customary and ordinary.
Correct. There's one other thing I want to add, and I think we've discussed this before, is if the payment is due on the 1st, it is late on the 2nd. There's a 10-day grace period, and that's when the late charge starts on day 11. But keep in mind, it's due on the 1st, late on the 2nd. So
if a borrower wanted to walk into our offices and drop a check off, could they do that?
They certainly can do that. We highly encourage just to use the online methods, but if they want to do it in person, want to meet with us, we can do that.
Okay. So our borrower has paid us now. We're all set up. We got payments coming in. You get that money. You got it in your hand. Now I know if it's a wire transfer through an ACH or bank transfer, what it might be, or one of these other mechanisms that gives you immediate use of funds. If you get a check from a borrower, though, how many days must you wait before you can issue that money back out?
We wait 4 days.
You want to make sure it clears, right?
Correct.
Okay. So once that's done, where does that money go? What do you do with it?
So once the check has cleared or once we have received the funds, number one, what we will do is we will pay the underlying lien holder if there's one. We will remove the escrow funds, hold it in a trust account. Then whatever's left, we deduct our fee and forward the remainder to the investor.
Okay. So pretty easy.
Correct.
And that's what a loan servicer should do in this case.
Right.
You know, we're not really an extension of the note holder per se. In other words, we don't make decisions to modify a loan. We're not really the collection agent.
No.
We're there to collect a payment and distribute it properly and protect people. And again, no Sohail, as I kind of call it, we're that fraud preventer.
Exactly.
Because borrowers can certainly take that money, put it in their pocket in a distressed time frame, and not make those mortgage payments.
Sure.
And we don't want that to happen out there. And so let's take a moment and explore escrow in that instance.
Mm-hmm.
And I know we talked about this a moment ago, but there are two distinct scenarios. One is where there is an existing escrow account in existence, usually because there's an existing mortgage company, a first lien. And then the other one is where there's not one.
True.
The property could be debt-free, or maybe the underlying lender just isn't collecting an escrow account.
Right.
So this check comes in, and in most cases that check is principal and interest, taxes and insurance.
Right.
How do you handle that, those funds?
So in a scenario where there's an underlying lien holder that also escrows for taxes and insurance, we don't hold funds in escrow for that borrower because there's not a need to. The underlying lien holder takes care of that scenario.
So that's just kind of like a pass-through, right?
It's just a pass-through.
Okay.
In a situation where either the property is paid off or has an underlying lien, which could be through a private lender or through a lender that does not escrow for taxes and insurance, we hold those funds in escrows. It is a trust account, specifically used for the purposes of taxes and insurance holding for our borrowers, and then whatever's left, the principal and interest, that's forwarded to the investor.
And that escrow account doesn't get touched by anybody, right?
It does not get touched by anybody. It does not have any other monies besides the escrow funds that are for the borrower.
So what about a situation, and I've seen two different things happen. One is where, because maybe there's an existing escrow account in place, but the borrower's escrow account may be, one, a little bit less money than the underlying debt. And then, of course, there's the other side of that where it could be a little bit more. What happens in those two scenarios?
So these are really good scenarios to discuss, because there are times where we are collecting less in taxes and insurance than what the underlying lien holder may be collecting. And for whatever reason, that calculation was done by them versus our calculation, which is spot on many times. So in a scenario where we are collecting less, we would have to take money out of the lender's principal and interest payment to make up for that difference.
Okay.
If there's a shortage, we have to make it up from somewhere. We can't just
You can't short pay the
we can't
lender.
short pay it.
Okay.
Now, if there's an overage where we're collecting more, for example, the underlying lien holder collects $300 and we're collecting $400, there's an overage of $100. We would hold that money in escrow for our borrowers up until the time when an escrow analysis is done by both the underlying lien holder and by our firm. And at some point, those numbers will start to match up.
Okay.
If we have any overage left at that point, that's returned to the borrower.
And I want to point out too that if, in a situation where the existing escrow at a lender's office, an existing lender, is more than what is being collected, somewhere along the way, there's going to be an escrow adjustment, and those dollars will come back to the note holder along the way.
Sure.
Okay. So get all that. So this simply, again, out of these dollars, do we collect our monthly fee also?
Yes.
And so the borrowers in most of these cases are paying principal, interest, taxes, insurance, and the service fee.
Servicing fee, correct.
Got it. So usually once a year, we may look at the escrow to see if there needs to be an adjustment, right?
Right.
It is possible we could have an adjustable rate loan or a step-up mortgage where the monthly payment adjusts also. So when it's time to adjust the payment, what do you do in that scenario, and what do you send to the borrowers?
Well, we will send out a notice indicating the changes, indicating how we came to, especially when it's an escrow adjustment, we have to provide them with the analysis and show them as to what the shortage is. Either they can make up the payment in one lump sum payment, or they can do it over 12 months if there was a shortage. Or if it's just an adjustment, then the payment goes up, we let the borrower know, and then they will make
the
payment.
There.
Yeah.
Okay. So you just look at everything, analyze it, make sure that if you do that analyzation, say, on April the 1st, there's going to be an adjustment, hopefully on May the 1st, and
Correct.
from May through December, that borrower is going to be paying more than they would be normally in order to make up for the January, February, March, and April payments, right? And that's the same way mortgage companies across the country do it too, right?
Correct.
So it's just keeping up with that, tracking it, and understanding it. So at year end, does OFN Loan Servicing send out a 1098?
Yes, we do. We send out a 1098 for the interest paid throughout the year, and it's done by the end of January. By January 31st, it's sent out.
And so let's say this loan is coming to its end. Our borrower is going to refinance. They're selling it. Is a payoff statement issued?
So the payoff statement essentially is via a request. Typically, a title company will make that request, or another lender. We'll just run the analysis, do the principal and interest calculation, and make the payoff go through whatever the requested date is, and then send it out to them.
Okay. And you're going to send that to whatever the party is that is requesting it, right?
Correct.
And guys, I want to make one very important issue. A closing agent should get that payoff from either the lender direct or that lender's servicer direct, not some other third party out there. That's just a protection mechanism so that fraud doesn't occur, because it can and it does out there every day. So those are great. Let's talk just one more moment about non-payment, because that's real life and it does happen. There's non-payment, there's late payment, and those kind of things. So again, using just a basic number, payments are due on the 1st. As you said, they're late on the 2nd. You have a grace period until the 10th.
Right.
So a payment comes in on, doesn't come in on the 10th. Do you send out a late notice?
We do. We also contact the borrower via email, text, and a phone call. Okay. And to let them know that the payment was late.
And so you're trying to collect that in some format. Sure. Got it. So let's assume it goes by, though, and it still doesn't come in. What do y'all do at that point?
Well, we will make a few attempts. We're not a hardcore collection agency by any means, so we will make a few attempts until the 20th of day of the late payment. The investor is made aware and is in the know as to what's going on, and we highly encourage the investor to reach out to their borrower to see if there's an issue that could be addressed, and potential foreclosure could be avoided.
Sure. I like the fact that we send those late notices out and make the attempt to do that. That's a positive issue there. Along the way, I know we've done a few things different than most people out there that do this business, and that is we're going to be a little bit more proactive on the collection process, in that when the payments are due on the 1st, late on the 10th, we have this 10-day period. And of course, I know we highly recommend that the note holder be proactive in tracking their payments, contacting their borrower, and checking things. Because only they're really the best person to collect their money, right?
And it's their borrower, and in most cases, they know the borrower.
Sure.
At least well enough to where they can communicate even more effectively than we can.
That's right. And again, I like that comment, they know their borrower, because I always recommend that they meet their borrower, understand it, you have that face-to-face. It does build rapport and things of that nature out there. But along the way, I know one thing we've put into place is that here, at least in the Texas marketplace, on the 20th of the month, if that hasn't been paid, then our recommended law firm is going to send out the initial pre-foreclosure notice, right?
Yep.
And we do that, guys, because what we don't want is the investor to sit there, not do anything, the borrower not pay, and 1 month goes by, 2 months go by, 3 months go by, yikes, we're getting further behind.
Yep.
And then they decide we've got to start getting some action done. So we're trying to help them get ahead of the curve and train the borrower to make their payments more timely, hopefully, for everybody out there. So in those situations where there is now a default, so it's not just a late payment, but now we got a default situation going on. Maybe it's a pre-foreclosure situation. Maybe that note holder and that borrower have made an agreement. If they make that agreement, what should they do to help you out navigate this?
Ideally, since we're not party to the transaction, what we recommend, and we've had this happen where we've asked the lender to get everything documented and in writing as to what the new agreement is. If there's a loan modification, get it to us in writing so we can adjust the terms and still not show the borrower being late and not be pursuing foreclosure or anything like that.
So the bottom line is you can't make the decisions.
The
note holder does.
Correct.
But they've got to get it to us as the servicer so we can implement it appropriately.
Exactly.
No, that is fantastic. So worst case thing happens. The property is foreclosed upon. Now the big obvious is we're not getting any more payments being received by the servicer. But maybe there's some funds still in the account. How is the disposition of those funds handled?
So the disposition of the funds at that point is handled by, we would disperse the funds to whoever we are asked to send the funds to by the trustee, the foreclosure trustees. We can't make that decision. We have to wait for instructions and then accordingly those funds are dispersed.
No, that's great. So guys, I hope that really helps you out in walking through the loan service process from start to finish along the way. We encourage you to take a moment, visit the website. We've got lots of questions and answers on there for both note holders and for borrowers. We have multiple videos that walk you through all the various items that there too to help you be more educated and make you hopefully a better investor, a better note holder, a better lender. So good luck, guys. I hope this really helped.
Thank you.